Hello, everybody, and welcome to this week's Options Play Macroeconomic Briefing. Investors and traders should closely monitor the following economic events scheduled for the week ending July 18th as they provide critical insights into inflation, housing demand, producer prices, labor market conditions, consumer spending, and also sentiment. For additional detail and to review the data tables that we're going to be showing here, be sure to check out the briefing that was emailed to Options Play subscribers. First up, consumer price index data. Both the month-on-month and year-on-year data will be released on July 15th at 8:30 a.m. Although core PCE is its preferred measure, CPI is a primary inflation gauge that influences Fed policy, as these are related. Higher CPI readings reduce the odds of a rate cut, while softer data supports easing. If it's stronger than expected, higher duration equities, such as growth stocks, are likely to fall, while value sectors, such as energy and financials, may outperform. Although the S&P 500 would be expected to be slightly weaker overall. Treasury yields would rise on falling rate cut bets. The dollar would strengthen on hawkish Fed outlook. Oil prices could rise with inflation, and gold prices would dip due to the higher yields. Weaker than expected, equities rally, tech and housing stocks gain, short-term yields would fall on dovish bets, the U.S. dollar would weaken, gold would rise, oil may soften if the data is interpreted as indicative of weaker demand. The MBA mortgage applications is also worth reviewing every week, and that's going to be released on July 16th at 7 a.m. Housing drives construction, retail, and financials. Weak demand raises concerns about growth, but eases pressure on the Fed to tighten. Stronger than expected, home builders and retailers are likely to rally. Yields may rise slightly due to optimism about demand. Dollar stable or strengthens. Oil would be stable, gold unaffected. If it's weaker than expected, housing stocks are likely to dip, defensives hold, yields would ease on slowdown fears, the U.S. dollar would soften, gold could rise due to both safe haven demand and lower interest rates. The Producer Price Index, or PPI, is released on July 16th at 8:30 a.m. and is essential because the PPI leads consumer inflation. A rising PPI could foreshadow higher CPI in subsequent reporting periods, reducing the odds of a rate cut. A soft PPI supports easing, stronger than expected, greater than 0.3%. Consumer goods stocks face margin pressure, energy likely gains, yields rise, dollar strengthens. Oil could rise while gold dips. If it's weaker than expected, less than 0%, a broad equity market rally with consumer stocks outperforming, falling yields, a weaker U.S. dollar, and a higher gold price along with stable or softening oil prices. Initial jobless claims on July 17th at 8:30 a.m. because claims reflect labor market health impacting spending and housing and are also part of the Fed's dual mandate. Rising claims fuel rate cut bets. Low claims support steady policy. So lower than expected, less than 230,000, cyclical stocks are likely to rise, yields edge up, dollar strengthens, oil rises on optimism about demand, while gold is likely to remain stable. If it's higher than expected, greater than 250,000, cyclicals dip, defensives gain, yields fall, the dollar weakens, gold rises, and oil dips. Retail sales advance data will be out on July 17th at 8:30 a.m. Retail sales drive nearly 70% of U.S. GDP, so strong data supports growth. Weakness raises recession fears. Stronger than expected, greater than 0.5%. Consumer discretionary and retail stocks are going to rally. Yields rise on growth optimism. The dollar would strengthen, oil would rise, and gold would remain stable. If it's weaker than expected, retail stocks are likely to dip, defensives outperform, yields ease, dollar weakens, and gold rises while oil falls. Finally, University of Michigan consumer sentiment data on July 18th at 10 a.m. Because sentiment drives spending, low sentiment risks consumption slowdown, supporting Fed easing. High sentiment delays cuts, stronger than expected, greater than 65. Discretionary stocks are likely to rally. Yields rise slightly while the dollar strengthens. Oil rises and gold would be stable. If weaker than expected, discretionary stocks dip, defensives gain, yields fall, the dollar weakens, gold rises, and oil would dip. Recent U.S.-China trade progress has eased some pressures, but tariff uncertainty, even after accounting for the delays on some tariffs this past week, raises costs and curbs demand. Some economists predict a 4% CPI by year-end, but 39 basis points of easing is still priced in. Strong CPI and PPI data this week or labor data delay rate cut hopes, while weak sentiment or retail sales spur dovish bets. That's this week's Options Play Macroeconomic Briefing. Be sure to tune in to the Open Interest YouTube channel for live streams where we take your questions. Trade well this week, and thanks for watching.